Now, I said I wanted to speak about one thing with regard to the to 960, the deemed paid credit, to illustrate something. Remember, I think I've said before that there's a parallel mechanism in Subpart F for the deemed paid credit that you get under Section 902 when there's an actual dividend. So in the Subpart F area, if you have an inclusion in income under 951, if there are taxes paid by the CFC from which the distribution, from which the income is included in the U.S. shareholder, then you have this parallel deemed paid tax credit under 960. Now, the issue that I want to point out is this issue of what I'll call the hopscotch effect. And it's not just the point of the foreign tax credit, but it's also the point of out of which company has there been an inclusion of Subpart F income. So here we have a second level CFC. And the first CFC, let's assume, has no Subpart F income. But the second CFC, CFC2, has, okay, not Subpart F income, but has an investment in U.S. property. That 956 investment in U.S. property that we talked about. In a later slide, or in the next slide, we'll get to a Subpart F inclusion. But first, we're just talking about an investment in U.S. property. Now, the CFC2, when it makes an investment in U.S. property, remember that the amount of the investment in U.S. property will be the lower of the amount of the investment, or the amount of earnings and profits in CFC2 that have not already been recognized by the U.S. parent. So there could be, of course, earnings and profits at CFC at the CFC level, CFC1, let's say, but that doesn't affect the calculation. There's sort of a hopscotch result. There's a jumping. You look in calculating the amount of the inclusion in income for the investment in U.S. property, you're only looking at the earnings which are in CFC2. What's in CFC1 does not matter. So even though the ownership may be 100%, you go direct. It's just the way the rules work. Now, notice at the bottom it says, but what about the foreign tax credit? And notice that we said that CFC2 has a high effective tax rate, whereas CFC1 has a low effective tax rate. And you may also recall that I've said at some point in the past that 956 can be easily triggered if you want to. If you want to get your deemed paid tax credits up into the parent, you can pretty much choose to trigger those foreign tax credits, those deemed paid credits, when you want to. Well, that's, kind of a nice thing for the taxpayer, but it's maybe not such a nice thing from the standpoint of from the government standpoint. Why allow taxpayers this kind of flexibility? And this hopscotch effect is that if you have the situation of high effective tax rate here and low effective tax rate with the other one, the taxpayer can pick and choose and trigger an investment in U.S. property only with the high tax CFC. Now, up until this year, this has been something the taxpayers can do because you calculated the 960 deemed paid credit solely with regard to the effective tax rate in CFC2. What was happening in CFC1 did not matter. So one of the changes this past August was to, in a sense, try to eliminate this ability to cherry pick and to bring up the high foreign taxes that you, of course, wanted to bring up. And they essentially did this not by changing any Subpart F rules as far as the recognition of Subpart F income or the recognition of investment in U.S. property. Rather, what they did was they said solely for purposes of calculating the deemed paid credit, you cannot claim more deemed paid credit than you would be able to claim if the amount of the inclusion from the investment in U.S. property had been distributed from here to here and then from here to there. So because of the pools, remember the post-86 pools of earnings and profits and taxes paid, what happens then is that you're diluting the high effective tax rate with the low effective tax rate and ending up with a lower deemed paid credit within the U.S. shareholder. So before this change in August, you would be able to have your investment in U.S. property and take a deemed paid credit at the high rates of only that CFC. After the effective date of this new rule, you've got to calculate it as if it's going through the CFC. There's dilution, and you end up with less deemed paid tax credit. Now, this is with regard to investment in U.S. property. And, of course, it makes sense to do this because the government doesn't want the taxpayer to game the system, be able to game the system so much and getting all these deemed paid credits up. But what about Subpart F income as opposed to investment in U.S. property? What about the foreign personal holding company income and foreign-based company sales and services income? Do you think they made the same change for that? What do you think, Jessica?
I would guess no, because Congress is not smart.
Well, actually, I think they are smart in this case. Perhaps surprisingly enough. Obviously there are many exceptions, many exceptions, but overall, it's if somebody is earning income which is foreign personal holding company income, foreign-based company sales and services income. Let's say more often than not, they're structuring it so there's relatively low foreign tax. Let's say you don't generally structure things that meet those kinds of tax haven rules, subpart F rules, if you're going to be paying a whole bunch of foreign tax. You just don't normally structure it that way. So on average, most of your situations where there's an inclusion in the U.S. shareholders' income for foreign personal holding company income, foreign-based company sales services income, usually there's going to be a, relatively speaking, lower tax rate in the foreign countries. If that's normally going to be lower, do you want to give the taxpayer the benefit of maybe having a higher effective tax rate by having the dividend flow through the CFC there, which is a high effective tax rate company? Yeah, you really don't. So as a result, the hopscotch effect is still there for foreign taxes when there's this kind of inclusion in income. And again, it makes sense. On the one hand, under 956, for the investment in U.S. property, you're normally looking at a situation where the taxpayer wants to bring up, highly taxed income, wants to trigger, deemed paid credits. On the other hand, this is not, in this situation with subpart F income, you're not looking at a usual situation where a taxpayer is trying to trigger something. This is the other way around. The IRS is trying to get as much as it can from the shareholder for the activities of his subsidiary that are tax haven type things. So what to take away from this, certainly nothing to memorize, but just understand that even though there may be 1, 2, 3, 4, 5, 6 tiers of companies, these inclusions in income are direct. And only for the foreign tax credit for this one particular thing, which is the investment in U.S. property, do you not have a direct, ignore all the companies in between calculation.